Luckily, what happened today went a little bit in the direction we wanted, but I'm gonna let Tyson kind of explain that.
Yeah, cool. So first thing that we will do is we'll just kind of go over what we want to talk about today. So of course the Fed met again this week, so they announced some preliminary stuff. And the hard thing, well, I'll get into that in a minute, but we'll talk about that. We'll talk about where we think rates are going based on what they said today. Some market conditions, kind of local, Utah, not necessarily nationwide, because we know that we live in a little bit of a different market than what the national trends show. And then Bliss will just talk a little bit about staying successful in what we've been given in this industry, right? All right, so let's get into what the Fed talked about today. So as expected, they raised their target rate by 25 basis points, which puts us right 5.5-ish%. That's the 11th increase in the last 12 meetings. So last time is where they took a pause, but now we're back up to increasing.
And I'm going to add just one thing in here, Tyson. I think especially as mortgage professionals, but it's really going to ripple into the real estate industry as well. Coming in September, pretty much everyone that's had their student loans on pause for 3 years, they're going to have to start paying them back. Also, what this is affecting is HELOCs and credit cards. And so we're going to see some real payment shock, I think, September through November, which is going to have a really big ripple effect. And I think it's going to really, and you can, tell me your opinion on that, Tyson, but I think that's really going to some of the inflation metrics that they watch. So this is really affecting people with credit cards, HELOCs, and then we add in now they have to, after 3 years, start paying back on their student loans. So
yeah, no, it'll be interesting. I mean, it's really hard because the Fed wants to see pressure on the economy without putting it into a deep recession. And there's opinions out there that run from, oh, we're fine, not a lot's going to change, to we're already in a recession and it's just going to get worse. So, I mean, there's tons of opinions out there, but I do think that the more pressure that's added, it will hopefully get the results we want, which is lower inflation, things like that. So future rate hikes will be contingent on the impact of previous rate hikes and financial development. So that's basically them saying it's not a guarantee that there will be another 25 basis point rate hike, which is good. I mean, they're basically kind of hedging their bets and saying, let's wait and see, not coming out and saying anything definitive. And then this is a quote from Fed Chair Powell. The process of getting inflation back down to 2% has a long way to go, and also bringing down inflation is likely to require a period of below trend growth and some softening of labor market conditions. So the inflation data has actually been pretty good. It's been consistently going down, maybe not as fast as we originally thought it would, but it's a labor market that's kind of been the surprise. That's still really strong. Unemployment's really low. So yeah, that's kind of the other factor. I mean, inflation will always be something to keep an eye on, but the labor market is another one that will be watched very closely. Okay, so that's a quick recap of today. And as of 147, mortgage-backed securities are up 25 basis points. So that's good. That means that rates will come down. Now, what's interesting, and that why I put that little timestamp on there, is often the next day we'll see a wild swing in the other direction. So tomorrow will be really interesting to see what mortgage-backed securities do. Okay, that's a recap. All right, now I like these. I've showed this dot plot before because I think it's really interesting and kind of fun. So it hasn't come out for this most recent meeting yet. But what we're looking at is each dot represents a member of the committee that votes on changing interest rates and things like that. So in March of 2023, So these are projections on what rates will be, what the Fed reserve rate, not mortgage rates, will be at the end of the year. So we can see this grouping was from March of 2023, and then June 2023, it was higher, right? We're kind of looking at what the majority thinks it's going to be above 5.5%. Well, this hike put us at about 5.5%. So this would indicate that we're probably going to see at least one more rate hike by the end of the year. And then out in the future, I think it's less informative. But again, this grouping from March is lower than the grouping from June. And then it gets way spread out. You can see out in the longer run. This I don't really pay attention to at all. I mean, what does that even mean? And I don't think it will be 2.5%. But anyway, I thought that was interesting. So if I had to pull out my crystal ball and make a guess, I would say there will be one more rate hike before the end of the year.
I'd agree with that.
Yeah. Whether it's at the next meeting or later in the year, I don't know about that, but I do think there'll be at least one more. Okay, I've shown this chart a lot before, and this is outdated, but my next slide has some updated numbers. But what I want to show here again is these times where mortgage rates, which is this green line, actually go down, can go down, and have in the past when the Fed rate is steady or even increasing. And so if we look at, so this is updated, green is the Fed funds rate with this is the most recent one, and then blue is our mortgage rates. We can kind of see that started to happen at certain points during the year, or this year and the past year. You know, I vividly remember this time period, kind of the middle of last year, where we were up around 6% and it dropped down to 5%. And I was like, great, we're going to settle somewhere in the mid to high 4s and we'll be great. And then it spiked all the way back up to 7. And then again, earlier this year, we went from 7 down to 6. And I'm like, okay, here it is. We're seeing that trend, even though the Fed fund rate is still increasing, we're seeing a decrease, but then we just keep creeping back up, and now we're right around 7 again. So this trend is really interesting to me, and I think finally everyone has kind of realized that we're in this for a little bit longer than initially thought. I mean, me and Bliss were, you know, we're saying, oh, this will last a year at the most, whatever, it'll stable out. And neither of us thought we would go as high as 7. So I think what we see now is maybe, I don't know, I hope we settle around 6.5 soon, and it may stay there for a while before it starts to drop down. But again, there's so many opinions and so many experts out there that I hesitate saying anything because everyone's been wrong for the past 6 months to a year.
The smartest people out there have been wrong about this. And so it's really hard to make a guess, but I would agree with Tyson. I do think we should be leveling off soon, stay there for a while, and then start to dip down.
Yeah. I think there was a lot of optimism at first. You know, back early 2022, we knew that rates would go up, but it was like, oh, we'll see a quick spike and then maybe it levels out around 4%. But it's been a lot different than everyone thought. So buckle up and we'll just keep riding.
Buttercup.
Okay, so where do rates go from here? I kind of mentioned this a little bit. I left this bullet point in here because when we talked in March, that was the whole thing, right? That was the hot news, was all the banks failing and things like that. That's become old news really quick. I haven't heard anything about that in a long time, but it is something that can have a big effect if banks start failing again. Inflation and other economic data will still be the biggest movers. Like I said, the labor market's one to keep an eye on. Rate volatility will likely continue. And then hopefully rates will consistently trend downward by Q1 2024. I revised that. The last time we met in March and did this call, I had Q3 2023. Well, we're pretty much there and we're not seeing that yet. So I'm going to give it another 6 months. And then if I'm wrong, I'll just revise it and call it good. So that's what everyone else is doing. Okay. All right. I want to talk a little bit about the Utah market, and most of this comes from the Kempsey Gardner Policy Institute. And some of you may have been to that housing summit a little while ago. Bliss and I actually missed that one, so I had to play catch up a little bit. But the housing shortage, we're down to about 28,000 units from a high of 40,000 a few years ago. Now that's good news. And it, that those couple of years, I think 2021 was the highest number of units, housing units added in Utah of all time. So that helped us really catch up. But the flip side is the shortage is expected to increase. That 28,000 is expected to get higher as builders slow down due to the higher interest rates. That was really interesting. Like even within Utah, there are a few like micro economies. For those that may have been on the call before we started recording, Kimberly was talking about St. George and how, builders aren't really worried down there. There's just a different market there with second homes and vacation homes and things like that. So even within Utah, there's these weird little pockets that don't behave as expected sometimes. But for the most part, building has slowed down. And because of this next point, the population growth, we're likely going to see that housing shortage increase again. And I thought this was interesting. Lehi was one of the nation's fastest growing cities, added 84,000 new residents. So that's pretty interesting. So what that means is when rates go down, we're going to be facing a new problem, and that's home prices increasing pretty rapidly again, because all those people that have put things on hold while rates are high are going to come back into the market. They're going to start shopping again. All right, so what's being done? That seems depressing, but there are things that are being done. They may take a while to kind of gain traction and actually make a difference, but it's nice that here in Utah, there's people that are aware of it and they're trying to take steps to improve it. So the first time home buyer program, that's the one that's new construction, 450,000 or under. It'll be interesting to see how that plays out. It's actually a pretty narrow scope of people that qualify for that or that even would want to use it. But it's something, right? It's a tool in the toolbox. ADUs, accessory dwelling units. There's been some interesting changes on this front. Obviously, the appeal to that, or the reason why that helps, is it creates more units with existing homes, right? With people converting part of their home into an ADU, or there's even builders building new homes with an ADU in them upon completion. So that releases some of the pressure on the market, where we don't need all this capital and construction to create new units. People can do it right within their own homes. So Utah law, as of a couple of years ago, now allows ADUs statewide. I know there's been a lot of kind of back and forth with cities and HOAs and things there, but for the most part, anywhere in Utah, you can have an ADU. One interesting thing, this is pretty recent, Freddie Mac. So there's Fannie Mae and Freddie Mac, right? The two conventional mortgage corporations. So Freddie Mac, one of them, now allows rental income from an ADU to be used as qualifying income. And that didn't used to be the case. Previously, you couldn't use any rental income from your primary residence. So the house that you live in, if you're renting a room or the basement, you couldn't use that income. But now, as long as it's a legal ADU with a lease agreement, you can use that income as qualifying income. So that's pretty cool. That's actually going to help a lot of people. Okay, and then decreases in regulation. The idea here is that by cutting some of the red tape, it's cheaper for builders, and that they pass those savings on to the buyers. That's the theory. Whether or not that happens is yet to be seen, but I mean, that would be great if we can make it easier for builders to get through that approval process and maintain the quality of the build, then that's better for everyone. Okay, and then this is a part where Bliss was going to take some time to talk, but she may have fallen off. Wonder if she lost. Yeah, I don't know. Bliss may have left. But what she was going to talk about, as I understand it, is just we are where we are, right? And so if you're in this for the long haul, then really the things that you have to do to continue being successful is maintain relationships and have good communication. And kind of the question that I think we need to communicate to everyone is, why is it still a good time to buy? And the kind of the script or the story that I continually tell is, yes, rates are high right now, and you have to make sure you're comfortable with a house payment now. But as soon as rates drop, home prices are going to increase again. And so even though it's like historically unaffordable to buy a house, it's still probably the best time to buy, because the future, the future looks good for lower interest rates, but it brings a new problem, like we mentioned, with higher home prices. Yeah, so that's kind of the thing that I talk to everyone about, is because there's always that sticker shock of when I present numbers, right? Your monthly payment's going to be $3,500 a month, and people really retract and think, whoa, I don't know if I can do that right now. But if they qualify and if they can afford it and make it work, then I try to explain to them that it is still a good time to buy. So yeah, I guess that this was kind of a shorter one today, but is there any questions or thoughts from what I shared, or any other ideas, any other ways that you guys are talking to clients to try to ease their worries a little bit?
I think sometimes just being able to talk with people and communicate, let them know that, you know, you're not you're aware of the situation, and it's okay to talk about it, and it's okay to, be in a situation where you have good support and help to go through the buying process, and that there are options on alternatives that you guys have been so gracious and good about helping people through.
Yeah, no, I think that's great, Wendell. Like, I think it's easy to kind of retract and not want to talk about how tough it is right now, but there's still good things happening. Like, there's still people out there that want to be homeowners and can see the benefit of it and want to take that step. So yeah, just talking with people and being real. I really like that approach. Okay, cool. Anyone else want to share?
I just always tell them buying a house is like planting a tree. The best time to do it was 20 years ago. The second best time is today.
Yeah.
And I know that rates are really high. Sorry, you get to watch my efforts here. Okay, you're really close to me. But I just remind them that, you marry your mortgage, you date your rate. And as soon as rates go down, prices are going to soar, which means their spouse is going to look so much better to them. So I just try to make it light and something that they can relate to. So.
No, that's perfect. Yeah, the tree analogy is great. Yeah, and then with rates, I think the only thing that maybe I've been a little more sensitive about is I thought by now the people that I closed at 6%, they'd be able to refinance at 5.5%, right? I thought we'd be there. And so I'm really cautious to make any sort of promises right? But it is true that at some point rates are going to cycle down. We just have to make sure that they're comfortable making that payment for a while, because who knows how long this is going to take. But yeah, once you buy a house, you bought it at the price you bought it at, right? That doesn't change. But as soon as rates go down, we will see some pretty quick appreciation.
I think the other thing that we're, I don't know, I haven't run into this until this week, and I've got a client that bought a home last August, VA, so there's a funding fee. At a purchase price of 470, but now with their VA funding fee and adding their closing costs in, their loan amount was 495. Well, she just lost her job and needs to sell, and her value is 475. And so having to find a solution for her other than selling her house. Okay, that's really hot. You know, renting it, but even at renting it, she's not going to cover her mortgage. So just trying to figure out like the best way, without promising that, hey, rates will go down. Maybe, you know, you can just get someone in there for 6 to 8 months, but just helping them find a solution that is much more viable than I have no way to make, you know, a $2,700 house payment.
Yeah.
It's hard for everybody who bought last year, who might need to sell this year. I think those are the people that are going to be in the world of hurt right now.
Yeah. So my brother and sister-in-law and their family are actually in that similar scenario where they bought almost exactly a year ago a USDA loan, so 0% down, and they're up in Idaho, and he just got a really good job offer down in St. George. And so now they're thinking, what do we do? Do we rent our house and then rent down in St. George, or do we try to sell and see what equity, if any, we have in it? So yeah,
Yeah.
there's some tough situations for sure.
Yep. I just met a couple walking around who said the same thing, and they decided not to take a great job because they didn't know what to do with their house.
Yeah.
So,
Yeah. But you know, that's what we are. We're problem solvers, right? Trying to advise people and do the best we can. Okay. Well, cool. Hopefully that was informative. In some respect, we will post this on our YouTube channel, and yeah, just stay in touch if you have any other questions, and we'll do a few more of these before the end of the year. Thanks, everyone.